everyone, and thanks for joining our Wealth Builder Real Estate Investing Workshops. Today, our masterclass is on passive real estate syndication, alive or dead. That's one of my favorite topics too, Brian. And today we have actually a celebrity guest with us, Brian Burke. He's my good friend. He's a true real estate expert with over 35 years of experience and an impressive 800 million in acquisitions. He's a president and CEO of Praxis Capital, Inc. Brian has led the charge in acquiring and repositioning thousands of multifamily units, as well as developing single-family homes and self-storage facilities. He's also the author of Hands-Off Investor, an insider's guide to investing in passive real estate syndications, making him a go-to authority for those looking to build wealth through real estate. So welcome, Brian. Super happy to have you with us today.
Yeah, it's great to be here, Vinki. Thanks for that wonderful introduction. I appreciate that.
Sure. So before we get started, I have a small little disclaimer and some Q&A items. So this session is strictly for knowledge sharing purposes and should not be considered a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. So if you have any legal questions, please reach out to your attorneys or your CPAs. And some housekeeping items, please use the Q&A box for any questions. And throughout the presentation, if you have any question, please go ahead and use the Q&A box, and we'll try to address your question live and try to answer it live. If by chance we miss your question or answering your question, please email me at vinki@loombainvest.com, and I promise I will reply back to you. And use the chat to connect with each other, introduce yourself. And Brian, stage is all yours. I already gave you the sharing session, so go ahead and share.
Well, great, Vinki. Thanks for the introduction and all that. It's certainly a pleasure to be here today to talk about passive real estate syndications. I'm going to share a screen that's going to have some slides that we'll go over for probably about the next 20 to 30 minutes, and then following that, we'll have an open session for Q&A where we can hopefully fill in any blanks that I didn't catch in the presentation slides. Vinki gave a great introduction already, so I won't spend a lot of time on talking about my background, but as she did mention, I started out as a house flipper 35 years ago. I flipped about, I think, 725 or 750 single family homes, something like that, over the last 35 years. A little over 20 years ago, it's coming up on 25 years ago, I got into multifamily and grew that multifamily business to where we were buying larger multifamily properties through syndication, migrated that into funds. And through the course of that, we've bought over 4,000 multifamily units, over 850 million in real estate. I had a lending company for a while. For about 5 years, we lent out over $2 billion to real estate investors. And then we sold that company to a publicly traded real estate REIT, which was nice to have a business exit. Kind of threw me into like a little semi-retirement phase for a while, and which was kind of nice. All this stuff that I've done was funded through the help of passive investors. Over 2,500 passive investors have contributed well over $350 million to over 40 offerings that I've done throughout the years. I'm also on the other side of the table as a passive investor. I'm an LP investor in real estate syndications, not just my own, but those from other sponsors. But I've also invested outside of the real estate space in private offerings for pharmaceutical startups, new drug discoveries, oil and gas exploration and production, agriculture businesses, and real estate lending. So kind of seen a lot of things on all sides of the fence in real estate and investing. On the real estate side, I didn't do this just by myself. I've got a good team behind me here at Praxis with over 100,000 units of multifamily experience amongst our core team. Over 40 years, 45 years in the business for some of these guys. And this is my, my core team. I was talking to Vinki when we first started up. I had a mastermind session this morning with some friends of mine that we talk about what they're seeing in multifamily. But outside of that, these guys are my day-to-day mastermind. These guys are part of my team. We work together and talk every day, and I get to tap into their wealth of experience in this business over the years. To help refine our approach and our ideas, and we've been working together for many years and bought a lot of real estate together. It's been a great ride. Our operational experience is all across the country. We've been mostly in the southern states, but we've had operational experience in some northern states. Certainly, our lending experience in our lending company was nationwide, so actually most states we had operated in on the lending side. Outside of investing circles, I'm probably best known for my book, The Hands-Off Investor. I wrote this book in part because a friend of mine lost her entire life savings investing in a passive real estate syndication when she invested with the wrong sponsor. And I felt that if there was anything that I could do to prevent that from happening to just one person, then the efforts to write this book would be absolutely worth it. And I think it's done its job over the years. This book came out 5 years ago, and I've gotten tremendous feedback, and hopefully it's helped some people avoid making mistakes in their real estate investing. So first, let's talk about what is a syndication. We'll start with the dictionary definition. The root word of syndication is syndicate. And the Oxford Dictionary defines a syndicate as a group of individuals or organizations combined to promote some common interest. In other words, everybody gets together, contributes money, somebody is in charge and acquires real estate, obtains financing, oversees operations, and eventually sells the asset. But not to be outdone, Merriam-Webster also has a dictionary definition for the word syndicate, and their definition is a loose association of racketeers in control of organized crime. So your job as a passive investor is to determine which of these two dictionary definitions the sponsor leading the investment fits into. It's probably the most critical decision that you're going to make in your passive investing career. If you look at what some passive investors are going through these days, one of the big things that I'm hearing a lot about is trouble in syndications. And it's not all because of, going back to the previous slide of racketeers in control of organized crime. It's not necessarily just for that reason. We're also in a really challenging and difficult market, and I'm going to get into that a little bit later as to why that is and what's really happening. But the effect of that is it's causing some sponsors, in fact, probably more sponsors than not, to pause distributions. And that can cause a passive investor to freak out. So if we've paused distributions, what does that mean? Does that mean that I've lost all of my money? Does it mean that the investment is doomed? And it might mean that, and it might not mean that. It's really important for you to communicate with the sponsor of the investment that you've invested with to get the answers to what's really going on. Hopefully, though, you don't even have to do that. A really good sponsor would be ahead of this and telling you long before distributions get paused what the warning signs are. But you'd be surprised that many do not. In fact, I've heard plenty of stories of people that are caught completely blindsided and off guard by their distributions being paused or stopped. So the question is this fixable, and is the situation likely to continue? Those are the things that you need to know. These are good questions that you need for the sponsor, and it's good things for you to think about whether or not the problem is fixable or temporary, and whether or not those distributions may resume again in the future. Doesn't necessarily mean your money's lost. It could be the sponsors being overly cautious, or it could mean that there's even worse trouble ahead. The other thing I'm hearing a lot about lately is capital calls. And a capital call is when, well, there's two kinds of capital calls. There's planned capital calls and unplanned ones. Planned capital calls are in a fund when you offer to invest, say, $100,000, and the sponsor is going to acquire 20 properties, and over the course of time, they issue you capital calls to fund those acquisitions up to your investment commitment amount. Not talking about those; those are expected. What I'm talking about are unplanned capital calls where you've invested in a syndication, you've contributed your full investment commitment, and then now there's a problem with the business plan. The distributions have been paused. The sponsor is asking you for additional funds where the cash flow is in reverse now. They're asking you to give them money instead of them giving you a distribution. And the question has to come up of, if I fulfill this capital call, am I throwing good money after bad? And there's a lot of things for you to think about in making this decision. What are the long-term threats? What's the current liquidation value? Meaning, if we were to sell these assets now, how much of my equity would I get back? And in some cases, if the answer is zero, it actually makes the decision easier. Where you know that uh, if you do fulfill a capital call and the business plan is successful, and you do ultimately get your money back, then that capital call was probably a really good investment. However, if you could get half your money back now, that makes the decision a lot more complicated, because now you think, well, would it just be better to get half my money back, reinvest that half, and be left with more from the reinvestment that I make? So lots of considerations on which direction to go. But I think what's most important is, does the business plan get you through the adverse market cycle? That, I think, is the real key. So often I'm seeing these days capital call webinars and capital call slide decks that are just saying, well, if you give us more money, we're going to pay our loan balance down by $1 million. The lender is going to give us a 1-year extension on our matured bridge loan. The property is worth less than the loan amount. We're in negative cash flow. When you stack all of those factors one over the other, there's a really good chance that the capital call that you're considering fulfilling is leading to nowhere. There's no real destination if all you're doing is kicking the can down the road by a year. On the other hand, it could be a scenario where the property is cash flowing, the loan is current, the property value is still more than the loan amount, or maybe even at least equal to the loan amount. If the sponsor gets all the called capital, this could carry them into the next up market cycle. If that's the case, then it's likely not throwing good money after bad. You really have to understand the circumstances of what's causing the underlying trauma and what the plan is to get out of the adverse market cycle and sell into a stronger market. So consider a lot of those factors when making your decision on whether to fulfill a capital call. But what about buying or making new investments, and making investments in new syndications? Should you even do that with all the things you've probably heard about syndications that are struggling and properties that are in trouble? Is real estate investing dead, and is syndications maybe just a bad business model that you just shouldn't even get involved with? I don't think it is. I think the opposite is true. As in, real estate always is like this. You have really strong markets, you have really weak markets. I like to say that there's a good time to buy and there's a good time to sell, but they're never at the same time. And it was a really good time to be a seller in 2021 when a lot of people were wanting to be buyers. And those that were buyers are now struggling, and that's why they just timed it wrong, and now the deals aren't working out so well. But if you get into a deal now and you're closer to the bottom of the market, that's a completely different scenario, and it's hard to relate one to the other and say, well, I invested in a syndication in 2022. It hasn't been working out so great. So, this whole thing is ridiculous. I shouldn't be investing in this stuff. I'm not going to make an investment now. Yet now may be the exact time you should be considering making that investment. So some of the reasons why, timing means a lot is if you look at today's basis versus the peak. For example, multifamily pricing. Multifamily, I'm going to mention a lot in this presentation because it's a really common property type for syndication because there's so much of it out there. A lot of the investors that invest in this stuff are investing in multifamily syndication. So I'll focus mostly on that, but I'll touch on some others. But if you look at the values of multifamily properties today versus at the peak of the market, the peak I would define as the second quarter of 2022. That's when pricing peaked in multifamily. By the third quarter of 22, pricing was in pretty much complete free fall. And that kept up until about 6 or 8 months ago. The free fall started to slow down and values started to stabilize to an extent. But prices are down considerably. So buying now versus buying in 2022 might be a very smart move if you compare your basis. But there are some risks. There's some unknowns. Things that are unknowns are cap rates, interest rates, rent growth rates, construction and absorption ratios. There's a lot of unknowns. Some of that is becoming a little bit more known. I think interest rates have stabilized to an extent where their movement, while still maybe perhaps unpredictable, we at least can have some level of confidence that they're not going to move by a lot in either direction anytime soon. They may move some. Construction and absorption, I think, is probably one of the big ones. There's been a lot of construction, not as much absorption. And that's caused a supply and demand imbalance, which is part of the underlying driver behind lack of rent growth that we've seen over the last few years. But that's starting to taper off. It's difficult to get a new construction project out of the ground now. Financing is expensive. Materials are expensive. There's a lot of tariff talk now that would increase cost of construction, like on things like lumber and appliances. So there will probably be even less building going forward than there is now. And when there's less building, that throws the supply and demand imbalance in the owner's favor. So then rent growth comes back. So, now may be a good time to get in when you think about that. Interest rates right now are often higher than cap rates. This is this debt cost versus equity returns. It's a situation called negative leverage. And this is impacting return. And to me, it's probably the biggest problem we have in a lot of sectors of commercial real estate where the cap rates that properties are trading for is lower than the interest rates you're borrowing the money for. And that just doesn't make any sense. So let's say you're buying a multifamily property at a 5% cap rate and you're financing at a 6.5% interest rate. That just doesn't, the numbers just don't math, right? You're supposed to think about real estate investing the other way around, where your profit comes from the difference between the interest rate and your cap rate. Well, right now the difference is negative. So that implies a negative profit. When you can buy at a cap rate of say 6 and finance at a 5% interest rate, now you have positive leverage and that's where you make money. But we're not seeing that right now in multifamily. And that's why I think that the multifamily market